When a trend possesses strong downward momentum, it often reacts at specific mathematical thresholds before continuing its descent. You might calculate a specific entry zone on your chart, only to watch the price action aggressively move right through it without hesitation. This breakthrough doesn't disqualify the level. By applying the 2.6 math strategy, you can identify when these broken levels are likely to become flip zone entries. To find these levels, you will need your charting platform, the price range tool, and a calculator. Mastering this reversal logic allows you to track price action as it transitions from one structural phase to the next, using a mathematical constant to locate the point of the flip. Start by identifying the macro trend on a higher time frame, like the 1-hour or 4-hour chart, to ensure you are trading in the direction of the larger move. Once the trend is established, move to the 15-minute chart to map the microstructure of lower highs and lower lows. Look for the break of structure, the moment price definitively pushes through the previous local low. Select the price range tool. We are going to measure the specific structural leg that created that break. Anchor the tool at the low that initiated the break and pull it to the high where the break of structure occurred. Take the value provided by the price range tool and divide it by 2.6. This calculation identifies a specific proportion within that structural leg. Adjust your tool to match this new integer and mark that horizontal area on your chart. This is your target zone for the flip. Using this division provides a fixed coordinate for your zone, basing the entry point on the actual price range of the move rather than a subjective line. In many setups, price should bounce off this zone. However, we are looking for instances where price runs through the level and fails to close back inside it. When price breaks through with this much momentum, the zone transitions. It is no longer a support area. It has flipped into a resistance level. Zoom into the 3-minute time frame and wait for price to return toward the bottom edge of this flipped zone. As price approaches the level, we look for the market to sweep liquidity, like a minor high or a double top, forming just before it reaches the zone. A liquidity sweep is marked by a wick piercing a previous high, while the candle body closes below it, indicating that orders have been triggered before the move continues. Mark this wick pierce with an X to identify it as a completed sweep. The entry occurs when price taps the flipped zone immediately after that liquidity sweep has been confirmed. Seeing this collection of liquidity suggests that the market has cleared local orders, which often precedes a rejection at the flip level. You can place a sell limit order at the threshold of the zone to capture the price as it taps the level. Set your stop loss between 30 and 50 pips, depending on the current volatility, to protect your capital. Return to the 15-minute time frame to identify where the price is likely to move next. Look for a minor structural consolidation halfway down the move to set your initial partial take-profit target. For your full target, use the previous major macro low at the bottom of the structure. This tiered approach allows you to secure gains at logical structural points while maintaining a position for the full extension of the move. Price reaches the limit order, taps the edge of the zone, and continues following the downward trajectory of the higher timeframe trend. When price hits the first target, you secure a portion of the trade and reduce the overall risk. In this example, the momentum continues until the price reaches the full take-profit target at the bottom of the range. The level that initially failed to hold a support was retested from the other side, successfully transitioning into a resistance zone. Open your charting software, find a 15-minute downtrend, and use the 2.6 calculation to identify a potential flip zone in today's price action.